Coming up in this show, Ari has a trade idea for you. Great analysis on KRE, a negative setup. I'm going to show you our special for level 4. This is a non-recurring membership. You're going to be able to buy it for 1 month and get everything that we do here on askSlim in this amazing offer. Then it won't renew. You just decide if you want to stay or not. I'm going to bring you Slim's take. The AI boom. Is it colliding with a liquidity squeeze? Man, you got to watch this. And then I'm going to bring you my analysis on the stock market. Multiple time frame analysis on SPX for all trading styles. And then we'll look at our MCM, the Market Condition Monitor, which has 350 symbols on it. And if you don't have it, you should get it.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
All right, if you're new to askSlim, do get acquainted here. And you have to just go to our website, askSlim.com, sign up for Snapshot Lite. It's free. On YouTube, subscribe to our channel, click the notification bell, and do like this video. Give it a thumbs up. And on X, follow us at askSlim. Any questions you have about anything about our memberships or anything I show you here, write to Matt at askSlim.com. This is a great trade idea. Ari's going to share superb analysis on KRE. And this is a great lesson on setting up an intermediate term bearish trade.
This is an askSlim trade idea video walkthrough for an intermediate term short idea in the SPDR regional banking ETF. That is the KRE. It is October 9th, 2025. So what we are going to first see is our askSlim MCM. Please note, if you are new to some of our offerings here, the askSlim MCM looks at over 350 underlyings using our indicators to give you a sum of the evidence bias across different time frames. You can see there is the intermediate term time frame, which is 3 to 8 weeks. There is the short term time frame, which is 1 to 3 weeks. There's the near term, which is around 1 to 5 sessions, and of course intraday as well. And what we have added in here on the right hand side is that now you can sort by what you want to see. If you only want to see the ETFs, you can do so. If you want to only see the stocks, you can do so. Please note, we have also added this in, which is cool. You can sort by industry groups, so you can see what groups are strong and what groups are weak. Let's actually first look at the ETFs because I want to highlight what's going on. And you can sort now by also trade setup conditions. So you can see again what is strong and what is weak. You can see what has been strong here. I'm going to now invert this and show you what's weak. You can see that it's the TUR, wheat, XLP, ARGT, XLRE. Let's keep going. IHI, ECH, KRE is there, ITB is there. XHB is there, right? Very, key sectors of the market to watch that are clearly weakening here. So all three of these actually we have been highlighting of late on the short side in individual issues. But I'm going to be looking at this short side opportunity here that I'm seeing in the KRE. Now, obviously it is super hard to keep track of what's going on across different markets, but that's where the askSlim MCM can help you, right? You can actually be notified of changes in bias. And what I have always said and what I find most helpful is to track for shifts, meaning when it goes from neutral to slightly bearish or from neutral to slightly bullish. So I would just actually check all these three and be notified via the askSlim desktop app when there's a change. Okay, so this is a very useful tool for you to be able to really track what's going on. So let's now highlight what's happening in terms of our weekly and daily cycle analysis. So on the intermediate term, you can see the RS was positive here, and you can see that we were really working our way up over time, and now we are curling down. If we look at what's going on in terms of our cycle timing window, there's a low that is due 9/8 to 10/27. So we are in a window where there are now increasing odds of a corrective period, given that the RS has turned down and that we are inside of that weekly cycle timing window. If we now jump over to the short term, this is where it gets very interesting. Throughout this whole move, you are only seeing a series of positive cycles with higher cycle highs, higher cycle lows, right? That has now changed. Look at what's happening in the RS. The RS has been holding red this whole time period. Even in that rally, the RS was actually negative. And now we are actually looking for this to fail somewhere around that 62.62, 63.20 area versus 64.59. And I'm going to be looking for this to move its way lower into that 61.29 to 59.75 area. That is the 61.8 to the 78.6. And there's a trough that is due 10.28 to 11.7. Okay, so this is our overall setup here in the KRE. We want to see acceleration below that low, very important, and that is at 62.31. And ideally, this really chops around a little bit and then starts to work its way back down like that. You do not want to see it really trade all that much through that high there at about 64. If it does, that would be a little bit of a warning sign about any kind of more meaningful weakness may no longer be in play. If you really start to see some buying through that high, you do want to see it at this point, given that we have now seen a series of lower highs and lower lows. You want to see that accelerate into lower lows. So this is our intermediate term short here in KRE, along with our logic behind the setup. If you want to see more of our trade ideas, as always, please head over to the askSlim.com website and click on membership options, and you can look at our either level 3 or level 4 offering. Thanks again, and I hope you guys have a great day.
Please do read this slide. This tells you about our analysis and how we approach our analysis on the markets and about how you use it. You got to take trade ownership. You got to own your own trade, no matter who gives you the information. That is how you're going to be able to protect yourself, protect your risk, and stay on your own trading plan. This is our level 4 top tier special. This is for first-time subscribers, or those of you that are on lower levels, either free or 1, 2, or 3. You can upgrade and see this amazing amount of content we have in here. That's our Market Condition Monitor Pro, which I'm going to show you in just a few minutes. You will then be able to see our multiple time frame charts, entire focus list. That's 84 of the top traded symbols, and there's so much more that's available to you because we give you a special grid to upload for the Thinkorswim platform that shows you, gives you essentially our Slim Ribbon PO, Reversal Scout, Market Condition Indicator, Option Bias Indicator, the SMI, and more. You can save this all onto your own platform. You're just going to love having that. You're going to get our Thinkorswim Grid archive. That's our top indicators with our analysts sharing all kinds of analysis that they have. That includes our bias heat map, which is just a fantastic way to see and sort on our own indicators. You get comprehensive support resources, Q&A with our team on Discord, webinars, videos, best practices for utilizing askSlim custom charts and studies, and everything in levels 3, 2, and 1. This is 37% off. It's only $99 for the 1 month versus $159, it will not renew. It's up to you. You don't like it? Well, it won't renew. You love it, or you want to go to a different level, we'll be glad to help you with that. Go to askSlim.com to sign up. And if you have any questions, write to Matt at askSlim.com. This is our front page, and you can see up here, special offer. Go up and click that up on the top right, and then you will be able to get more information and sign up for this special non-recurring level 4. This is Slim's take. The AI boom? Watch this. The AI boom, is it colliding with a liquidity squeeze? Well, this is a very important thing to discuss right now. This week, the alternative asset managers like Apollo and KKR and Blackstone, they've come under pressure, pretty significant pressure. And I don't think it's all about rates. I think it's about the changing shape of liquidity in this age of AI. Those of you that may not be familiar with Apollo or KKR, they're big private equity titans, and they play a big role in MA and everything, and about the private equity placement of money. Apollo, they're originally in the junk bonds, and they built themselves around credit and high yield loans and structured finance. And you can think of it as pretty much a credit factory. They at times own equity in things that they allow, that they do put investments in and borrow money to. KKR, well, that's a classic leveraged buyout company. That's in their DNA. And they're huge in private equity, and they have a credit arm that's grown really quickly. And they are kind of an equity-led, credit-supported type company that just loans huge amounts of money to company through their private sources. Both are weak now because the credit markets are getting tighter. So deal flow is slow, and funding costs remain high. Even though the Fed is come down a little bit, those costs are very high, very relative to what we've seen in the past couple of decades. So they need to get their profit from lending, and that's a problem for them when liquidity is drying up. The AI build out, well, they are really capital hungry, those companies, and they're not generating cash based on the amount of money that they're laying out. While the AI revolution is certainly real, it's not self-funding. The global AI infrastructure build out is massive. Data centers, chips, energy, networking. It's multi-trillions of dollars. It's estimated by 2030 to be as high as $6 trillion spent. The returns on that, well, currently they're almost nothing. I mean, just tens of billions of dollars. It's a fraction of what's being spent. The result is a huge amount of cash is needed to sustain the boom, and it far exceeds what the Mag 7 can generate. The Magnificent Seven are spending massively on AI infrastructure, and the free cash flow is shrinking. Profits are up modestly, but capex is just going through the roof, and the balance sheet levels are flat or falling for the first time in a decade or longer. That means that the next phase of AI build-out will need outside financing, borrowing. It is not self-funding. So big tech, once the market's main source of liquidity, is about to become a major borrower. Global aggregate spend on AI for this year, about $2.7 trillion, and global aggregate profits for 25 are at about $40 billion. That's a 1.5% payback. Well, you might say, well, they're spending the money now to be able to make money later. Yeah, well, 2028, 2030, best case is their ROI is going to be about 12%. And that's everything going absolutely right. And that's on a $5 trillion or $6 trillion spend. They cannot make a mistake. And believe me, there are companies that are going to make mistakes. So as this big tech borrowing for data centers and these power projects and private credit and infrastructure all is built, then you have to get this private equity to step in and help them build it with money that they're going to borrow from them or other sources that they're going to borrow money. Apollo, KKR, Blackstone, they can fund projects on the long term, as long as they're getting a big yield, and that's what it's going to take for them. And right now, there's some, as these stocks fall, they're falling also because there's been some significant bankruptcies that have occurred. So they're going to be a little bit tighter, and money's going to be getting tighter. Eventually, it's going to be bullish for them because they can loan money at high rates as money gets more scarce. But for now, liquidity is tight and the spreads are wide and funding is very expensive at the moment, especially for these massive deals. So the AI trade, it's been driven by hype and earnings multiple expansion. We've seen these valuations go through the roof. The next stage will be driven by who can afford to fund this infrastructure. And investors are waking up to that reality, and that's why credit-sensitive stocks are leading on the downside right now. And I'm going to show that to you. AI is real, but capital consuming. It's not capital generating. And what we have here is that Apollo, KKR, they have credit equity exposure, and they're both under pressure. And that source for money is going to be tough now for this AI build-out. The AI build-out is trillions in spend and billions in profit. I want to show you a chart right here that I think is important to what I'm telling you. And then we're going to look at the charts of these stocks. Look at this. This is illustrative of liquid assets versus estimated AI-related capex. Looking at these 5 mega stocks right over here. You see that Microsoft, they're going to be spending about 52.9% of liquid assets in 2025. Alphabet, 78.7%. And look at Meta, 165%. They are going to be burning cash like crazy if they can't borrow the money. Amazon, 166.7%. Nvidia, which has a huge amount of money coming in, that's one of the stocks that, it makes sense that they're going to be doing better profit with better profits, and that's why the stock has done so well. But they're still up near 50% of the money that they have coming in, the money that they have in liquid assets versus what their spend is. So you get a good idea as to the massive borrowing needs that these companies are going to have. So cash is thinning. You can see that, and borrowing is next. And liquidity cycle is tightening, and the credit markets will decide how far this boom can really go. So that was the lead-in to what I think is a problem for the AI stocks, for the mega caps, and for it continuing to support upside move in a market that has a valuation that we've never seen before. So let's take a look now at these important stocks. We'll look at KKR, APO, BX, and then we're going to look at an important chart, which is HYG, the high yield bonds, versus the S&P 500. They are all showing you problems right now. And that's why I thought this was a very important thing to bring to you right now. So let's take a look here. This is the KKR chart. I just happen they have cycle brackets in the bottom so you could see the money flow rhythms that are in the markets. And look what happened here. This is where the stock turned down in August of this year on the weekly chart. And our projection takes it out to near the year end on the downside, or maybe into early 2026. This downward turn here that you can see there on our reversal scout was a negative that occurred. You could see it tried to make a double top, but then failed big. And you can see the value of the reversal scout. This is where it turned up, told you that this was the upward phase that had in there. This is where it turned down, and that declining phase takes you out into the early part of next year. Let's take a look at APO, which is going to have a similar look to it. This is Apollo. These are all these private equity companies. And you could see the high actually was made here in 2025. Here's where you got the upward turn, and here's where you got the downward turn. And again, this points to declining prices out over here into 2026. These are the companies that are going to need to loan the money to AI that things are getting tighter for them. The question is, how is AI really going to get supported, and how big are these interest rates they're going to have to pay in order to finance this huge build out? You can see by the chart I showed you earlier that it's not going to be self-financed. They're going to have to borrow money because they're spending way, way above their own ability to generate liquidity. Last one we'll look at in here is BX, and a very similar look in here. You could see this points out to a decline out into early next year also. This just now is turning lower, that you can see right over there, and that is a sign that you're going to get this particular outflow of funds to take you out for probably the next 2 to 4 months on the downside, and that's not a good story for the stock market. But let's talk about the stock market here as it relates to the HYG, and I think this is very important. This is high yield versus the SPX. This line over here right there is the SPX that you can see in the chart, that line right there. And generally high yield bonds, or high yield, this index, trades with the stock market. You can see the rhythms in here of the S&P 500 with the high yield as it trades, and this was the big break here in earlier this year in 2025, and then this rally period. And now you can see as the stock market has continued up, this has now turned down, and the reversal scout is turned down. And interestingly, these rhythms, these money flow rhythms that we see in here, point to a further decline over here out into end of this year or the beginning of next year. So this S&P 500 that's hanging up here, it's kind of that Wile E. Coyote thing where it doesn't know, or investors don't know, that it's run off the cliff. All of this pressure from the financial side, I think, is significant. And I think that the whole story about the AI boom and the fact that it's going to run into a liquidity squeeze is really true. And we have to be very cognizant. If you start to see these stocks weaken, and they've been very strong in this last week, as a lot of news has come out that has supported the AI stocks, well, you know, if they start to weaken, this is the reason why. Investors getting the picture that they have massive borrowing needs. Their spending needs are just off the charts, as their massive amount of capex and the amount of build out that has to happen, even in energy, to be able to run these data centers. I mean, it's just enormous. It's going to put a huge pressure on electricity, on the cost of electricity on the upside. There are just so many factors involved. And the investors have gotten way out over their skis on this one because the prices have just gone ballistic, because they're betting on these returns out near 2030, which right now they're unproven, and any mistake is going to be very costly. That's the look at the AI boom. Is it colliding with a liquidity squeeze? I think so. Market brief. Well, this has been quite a week. Stocks moved upward to records again, though much choppier. The government shutdown continues, but it's not enough pain yet to end it, and I assume in the next couple weeks that will happen. They'll start to feel the pressure. Gold surges over $4,000 and silver tickles $50 an ounce. Bitcoin gets back up to about 125K before Thursday's reversal in all of them. AI was still leading on the upside, helped by the AMD OpenAI deal and all of the discussion about the infrastructure build-out. If you didn't watch Slim's Take yet, which is a segment on this show, you've got to go back and watch it. I talk about this AI boom. FOMC minutes, well, inflation persists, as they say. On tariffs, they say the labor market is weak, and they are still expecting 1 or 2 cuts ahead in 2025. The interesting thing, of course, is that one person, that's Mirren, who was the plant on the FOMC by President Trump, wanted a 0.5% cut, and that makes sense because he was put there to do that. Friday, well, this was the big day of big moves. China-U.S. trade war back in the news. Stocks get crushed. Well, China put restrictions on rare earths, or tightening that up, and brought forth an antitrust investigation on Qualcomm, added import fees on U.S. ships, and President Trump exploded. He canceled, or threatened to cancel, I'm not sure what's true about that yet, a meeting that's planned with Xi, and he warns massive tariffs are coming. Well, this is at a perfect time that the stock market really got way ahead of itself on the upside, and you see that kind of news really set it off as the stock market moved from, with the S&Ps up 20 points or so early in the day, to fall to down minus about 110. Now here at noon, as I'm bringing you this, right now it's down about 100 points on the downside, and the stock index is overall now lower on the week. Some of them had been up a little bit, but now down fractionally to about 2% on the downside. And the question is this the start of something, or is it a head fake? Well, we're going to look at the charts in a couple of minutes. So let's look at the S&P 500. Now, I'm only going to look at the S&P 500 today and share some analysis with you that I think is important. And I want to remind you that on Future Speak, which is every Wednesday, Arvi does a brilliant job bringing you updates on all of the commodities that we look at: metals, currencies, foods, energies, crypto. And he'll also bring you the not only the review of the S&P 500, but the NASDAQ, the Russell. He looks at all of those things. So it's every Wednesday for levels 2, 3, and 4. So, of course, if you take the special we're running now for level 4, you will get that. And level 2, 3, and 4 also get our full library, which has more than 1,000 videos in it. There's about 300 plus evergreen videos of all the teaching that I have done or the team has done. So you would absolutely love that. And don't forget to go to Slim AI. You can ask questions. If you're brand new, go to the front of the website, and you can just talk about, with me essentially, my virtual twin, about what askSlim is all about, and he'll give you some educational answers there about any questions you might ask, except he will not tell you where anything is going, so you don't even bother asking that question. All right, so let's move forward as we look at the S&P 500 chart. So this is the weekly chart in the S&P 500. There on the bottom are the cycle brackets. That is essentially a drawing tool that helps us see flows of money. That's what it's really about. And the flows of money are rhythmic. And the nature of the formations of those cycle patterns give us a sense for market conditions. Add into that where we look at our reversal scout here, which I love to have up on a weekly chart, but a lot of our analysts, there's 4 of us, put the slim ribbon on there. They may use other indicators. I happen to just like to keep it clean right now and to use this, and then I add in the slim ribbon and other indicators, which I'll show you on the daily chart. So this is where you see the upward turn, and it told us right there that was the beginning of that cycle right there. That same thing happened over here, as you could see. This was so strong where it only corrected 3% that the reversal scout never turned down. Then it started to get choppy in here when this top was being formed, and then this big break over here and the tariff panic that happened into early April or late April of this year. So we had this massive upside move. Now this right over here, this reversal scout and this upward pressure is important because it's a dominant force and affects all of the shorter terms. That would mean that the daily, the 2-hour, however you look at interdays, would all be affected by this because the downside would not be very strong because this upside pressure prevents it. We use a word like this as swamped, which says that this decline right over here, which is this minor cycle, couldn't even fall. And there's a minor trough that formed right over there, and then it started to move up again. Now we have this reversal day bar this week, and course, we're still open here at midday on Friday the 10th, so we don't know how that's going to finish, but we've talked about this time frame in here as a corrective period. We consider this to be the period of risk, where the dominant and the minor forces are coming down, and that's where you get liquidations, essentially. It could be mild here. We had a 6% here, a 3% here, of course, a 20-something% right over here, where you had that big major decline. But this rally went so long and this time period so brief that we would expect that it would be able to make an important bottom in here over the next, I would say, 3 to 6 weeks is what it looks like right in there. So with the downside target right over here, this minor support is about minus 4%. You can see that right there. And if you get to this dominant 23.6, that's 6.8%. So we'll just look at these numbers here, 64.87. This number over here is 64.21. And this 23.6% is at around 63.02. That's only a 6.8% drop. Any of these could happen during this time period. And if this issue of the reignited trade war that we're hearing going on here on Friday, if that really becomes a big issue, this decline could be quite sharp. And with the valuations, which I promised I would not say the word again, well, I lied, with the valuations this high, the declines, the reactions, just a modest correction could easily be, in that 6, 7, 8%. This right over here is that cycle low, and that would be down about 8.2%, just around 6,200. So any of those numbers could happen in here. This corrective downside force that you can see is very commonly pushing the market down in all of these periods. And that's where we are right now in this, what I consider corrective phase. Now let's look at the daily chart. So I'm showing it to you a little bit differently now. I don't have cycle analysis on here because I want to really focus on the slim ribbon and momentum indicators. Here's what's going on right now. First of all, we're looking at the slim ribbon PO, reversal scout, and the option bias indicator. Slim ribbon is a free indicator, and that's available for thinkorswim and for Tasty Trade and for Wealth 365 charts and TradingView. You can have it on any of those. If you want to put it on thinkorswim, we have that script for you to download. Here is that slim ribbon. Here is the slim ribbon PO. So when the slim ribbon, I told you on this weekly chart, is moving up, the weekly chart is pushing it up, as you can see, and the slim ribbon acts as a support area. Here it only got under it for a day and then popped right back up, and here you could see it's getting under it again. So the question is this an important break? If it has another down day under it in here, you'll know it's important. Also, the slim ribbon PO on the bottom, this is giving you these upside arrows, which tells you about momentum resumptions on the upside. You can see how great it is. It really works. This is the option bias study on the bottom, which says to you, keep your option positions biased on the long side. If this gets worse in here, then this will turn blue and you will not get a resumption area. This will turn yellow, it will go to neutral, and then potentially turn red as you head back over here where it was telling you to stay short until this period right over here in the end of April, beginning of May. So here's where it turned positive, it stayed positive the whole way, and now we have this down day, and our indicators still positive. And I'll show you the MCM, the market condition monitor, and that will show you that, well, the short term is still positive, but we're getting some negative changes on the near term, which is important because that's how it will start. So this is the look at it without cycle analysis. Let's just go now to our cycle analysis, and you can see on here. So we were looking for this downturn somewhere in here. We weren't sure. We've been moving these cycles around because they're very unreadable when you get into these periods where the market doesn't have any dips. So we really can't tell. So the question is, is this what we're looking at, this cycle that should have bottomed in here, but there's no trough at that point, and this came really late. That had me looking at this trough right over here, which I had rejected before as the possibility. But then I got an email from Steve P., who's a student of this work, and I was looking at it again, and I said, well, that probably is what's going on right over here. So if I just bring this in a little bit right here, you could see that somewhere over here, these cycles are pointing to the downside, and you can see in here that this really looks like it's getting through these supports and maybe to that cycle low, and it's pointing to the downside in here. So somewhere right over here is the end of October, beginning of November, and you can see that's what we're looking at. This looks like a decline that is just starting. If it breaks, look at this upward channel and how it just got down to it right here. If it breaks under that level, 66.10 approximately, gets under the support right over here at 65.68, that's going to be your message. Then all of these indicators are going to be turning negative, and the market's going to be in trouble, and it can really sell off hard to those levels that I discussed right over here, down as low as 66, near 6,300. This is near 6,200. That could happen in here. And important number, as you can see in that uptrend right over there, if it gets under that level, which is just around 66. This level, 6,600, this level here, important level around 65, 68. Gets under those, we're in trouble on the downside. Not sure which of these cycle rhythms is right, because as I said, when you have these big upside moves, then there's no clarity. Here you could see there was clarity because the market was moving to the downside or had volatility. Speaking of volatility, let me just look quickly at the VIX right in here, because the VIX is popping. And this is exactly the spot we talked about it popping. I mean, this is just perfect. As we expected it to go up there on the daily chart. Here it is on the weekly chart. We've been pointing to the upside right over here, and this is coming at the right time that we expected. So the S&P 500 and the VIX well in alignment, and really looking for this decline that we see here in the S&P 500, which right now is down 117 points on the day, looking like it's going to break that support and looking like it's headed down somewhere. I'm going to guess 6, 7, 8% on the downside for what is a fairly modest correction over these coming weeks. Let's take a look here as we look at the market condition monitor. So this is our proprietary algorithms that are built into this. It is fantastic. This is available for level 3 and 4. The difference is level 3 doesn't get the intraday that you see right over there. Level 4 does get all of that. So here we're looking at short term, and what's happened in here is that the indexes for the short term, which were bullish today and yesterday. You can see here yesterday that turned neutral for the IWM and the DIA. Today those turned neutral. So what was very bullish conditions has ended. The intermediate term, which we'll look at right over here, is still very bullish. You see, it's going to take some time for the deterioration in the shorter term to affect the intermediate term. So as long as it's like this, we're going to say, okay, this is a modest correction. Somewhere, 6, 7, 8% on the downside is reasonable. So there's your short term right over there, and you see neutral. But when you go to the near term, where you're really looking at, people that are traders or holders of just a few days, these are now turning slightly bearish to bearish. So this is the sign of the deterioration just starting right now in the market. Very important when you look at that. So back to the short term, you can see I have these bells are over here, and we have an application where you can get notified on your desktop, and I have this set to tell me when it turns slightly bearish, so that I will know when those things are getting worse. Let's just take a look at trade setup conditions in here. For all of these symbols that we're looking at. So you can toggle here, all stocks only, ETFs only, but I'm going to look at everything right now and say which ones are still very bullish. You can see that right over here, as the stocks that are very bullish are very apparent right there on the short term. We'll just run this down a little bit further so that you could see a few more of those. And if you want to look at the ones that are very bearish in here, you could see those right over here. As you see, HP Incorporated, Airbnb, Progressive Corp, Honeywell, Atlassian, Deere, those are very bearish. As you can see, let me just scroll down a little bit further in here, and you'll be able to see the ones that are more negative. So Apollo, I just gave you that. If you watch the special I did on AI stocks earlier on Slim's Take, you'll see that I discussed Apollo in there, and you can see the stocks that are very bearish. So this is really just a great way to see when things are changing. If you would go to the near term right over here, it's telling you the ones that are changing today that have gone very bearish right over there. If you're an intraday trader and you take level 4, then this will also help you with that and show you which ones are very bearish or very bullish based on what's going on today on the intraday right over there. So just a great application that you can see that we use, and I think just a great way to look at the market. So we looked at the S&P 500 and the VIX. It looks like things are changing in a fairly significant way, and you could say it's because of a potential trade war, but at the same time, you have to say to yourself, there's more to it than that, and it doesn't take much to prick a bubble. That's probably what's happening right now. Let's see what happens in the next few days and if our indicators turn negative. That's everything I'm going to show you today on the stock market. You saw our MCM. Make sure you get acquainted with us. Sign up for Snapshot Lite. It's free. Go to the top of our website, the free stuff, and you'll get Matt's fantastic analysis every single day. On YouTube, subscribe to the channel, click the notification bell, and do like this video. Give it a thumbs up. On X, follow me at askSlim, and any questions you have, write to Matt at askSlim.com. That's it for today. I want you to be so careful. It's so crazy out there, and I'm always wishing you great trading.
Well, I'm going to the city.